Welcome to The Explainer. Today, we're jumping right into the mechanics of what is, without a doubt, one of the most powerful tools you have for building long-term wealth, the hidden engine of tax-deferred growth. Listen, whether you're literally just starting your investment journey, or you've been putting money away for a while but never totally grasped the underlying math, this concept is an absolute game changer. It's going to completely shift how you look at your retirement accounts.
To really wrap our heads around how this works right out of the gate, I want you to picture something for me. Imagine planting two identical trees. You let the first tree grow completely freely for 30 years. Just let it do its thing. But the second tree, someone comes by and prunes off a chunk of its branches every single year. So which tree is going to be bigger at the end of 3 decades? Well, it's pretty obvious, right? The untouched tree gets massive because it gets to keep absolutely all of its growth. And honestly, this is exactly how your money works when you factor in taxes.
So here's our quick roadmap for today. We'll define this wealth-building engine, compare the exact timing of when you get taxed, visualize that massive compounding snowball effect, walk through the strict rules you've got to follow, and then wrap up with a quick exam review to lock it all in.
All right, Section 1, the wealth-building engine. Let's nail down exactly what deferral means for your hard-earned money.
Now, tax-deferred growth sounds incredibly dry, like some boring accounting jargon, doesn't it? But trust me, it is a massive wealth engine. All it really means is that your investment earnings, so we're talking the interest you accrue, the dividends companies pay you, or the capital gains from your stocks going up, they aren't taxed in the year you actually earn them. Instead, you postpone or defer paying those taxes until you finally take the money out much later down the road.
And here is the really reassuring news. You probably already have access to this protective little tax bubble. It's built right into common retirement accounts. So, if you've got a traditional IRA, a traditional 401k through your employer, maybe a 403b if you're a teacher or in healthcare, or even certain annuities, you're already using a tax-deferred account. Inside these specific accounts, you don't get hit with a tax bill every April for the growth happening inside them. That money that would normally go straight to the IRS, it gets to stay put and keep working for you.
Moving on to Section 2, pre-tax versus after-tax. Let's dig into the actual mechanics of when that tax bill hits, because, not all retirement accounts work the exact same way.
The most crucial thing to understand here is the timing. Think of it in two main categories. First, you have pre-tax, which is our tax-deferred bucket. With something like a traditional 401k, you generally get a nice tax deduction today. That lowers your current taxable income right now, giving you an immediate benefit, but you pay the taxes way later when you withdraw the funds. On the flip side, you have after-tax or tax-free accounts. Think Roth IRA here. You get absolutely zero tax deduction today because you're putting in dollars you've already paid taxes on. But the trade-off? It's incredible. Your qualified withdrawals in retirement are completely tax-free. So basically, you either take a tax break today to postpone the bill, or you pay up today to totally eliminate that future bill.
Let's put some real numbers to this to make it super practical. Let's say you earn $80,000 a year, and you decide to funnel $10,000 into a traditional 401k. Because that contribution is pre-tax, the IRS looks at your taxable income for the year and says, oh, they only made $70,000. You instantly lower your current tax bill, and at the same time, that full $10,000 gets to go straight into the market, totally untouched by taxes. Why does the government allow this? Because they desperately want to incentivize you to save for your own retirement instead of blowing it all today.
All right, Section 3, the compounding snowball. This is where things get really fun. Let's look at how money earning money, when you combine it with time, builds unstoppable momentum.
You've probably heard this before, but Albert Einstein supposedly called compound interest the eighth wonder of the world. Compounding is simply your money earning money, and then those new earnings going out and earning even more money. And the absolute fuel for this engine? It's time. The longer you leave that money sitting inside your account, the more explosive that compounding effect becomes. I really love thinking of compounding like a snowball rolling down a mountain. As it rolls, it naturally packs on more snow and gets bigger, faster, and heavier. Now imagine if every 10 feet someone stopped your snowball and scraped off 20% of the snow. It's never going to get that big, is it? Well, annual taxes are basically that guy scraping off your snow. In a regular taxable account, that tax money leaves your balance forever. It's gone. It can't grow anymore. But tax-deferred growth? It keeps your snowball completely intact, so it rolls faster and gets ridiculously larger than it ever could otherwise.
Let's look at the cold, hard math on this. Let's say you invest $10,000 and get an 8% return over 30 years. If you do this in a standard taxable account, where you have to pay, say, a 20% tax on your gains every single year, that 10 grand grows to about $64,300. Not bad. But If you take that exact same $10,000 and put it in a tax-deferred account where you pay zero annual taxes along the journey, it hits an unbelievable $100,600.
Think about that for a second. That is an extra $36,300. You're generating over 50% more wealth simply by changing the wrapper around your money. All because you delayed the tax man and just let that money endlessly compound. It's a total game changer.
And remember, time is the magic ingredient. If we map out that same 8% tax-deferred growth over a longer 40-year timeline, look at the exponential curve. At year 10, you're sitting at around $21,000. By year 30, you've crossed $100,000. But look what happens by year 40. You've got over $217,000. Notice how the growth in just those last 10 years adds more overall wealth to your bottom line than the first 20 years combined. That's the snowball at maximum speed.
Okay, Section 4, Penalties and RMDs. Because, let's be real, the government hasn't forgotten about you. There is a catch to all this incredible growth. If you take absolutely nothing else away from today's explainer, please remember this rule. Tax-deferred does not mean tax-free. Seriously, don't confuse the two. You're just delaying the inevitable. Eventually, the IRS is absolutely going to collect its due.
Because of that delayed bill, the government sets up some pretty strict rules you have to play by. First, when you finally pull that money out in retirement, it's generally taxed as ordinary income. Second, and this is big, these accounts are strictly for retirement. They're not for buying a new car next year. So if you withdraw the money early, before you hit the specified retirement age, the IRS is going to hit you with hefty early withdrawal penalties. That's a major drawback if you think you'll need flexibility. And finally, you can't just defer those taxes forever. Once you reach a certain age, the government steps in with required minimum distributions, or RMDs. They literally force you to start taking taxable withdrawals so they can finally get the tax revenue they've been patiently waiting decades for.
All right, Section 5, Key Differences. Let's run through a really quick exam review to give you a concrete mental cheat sheet before we wrap things up.
This breaks down the ultimate choice you face as an investor beautifully. If you go the tax-deferred route, like a traditional IRA, you get your tax break today. Your annual growth isn't taxed, but your withdrawals are taxed as ordinary income later. Your whole goal is just to postpone the tax bill. But if you choose the tax-free route, like a Roth IRA, you get absolutely zero tax break today. However, your growth still isn't taxed annually, and the kicker is your qualified withdrawals are entirely tax-free. Your goal there is to completely eliminate that future bill. Pay now or pay later.
You know, people spend so much time stressing out trying to pick the absolute perfect stock or perfectly time the market. Actually, scratch that. It's not even about what you earn. It's about what you keep. The real secret to building wealth is simply keeping more of your money untouched and letting it compound for as long as humanly possible. The true power of tax-deferred growth is all the money you don't lose to taxes while your investments are still doing their thing. So, I'm going to leave you with this one provocative question to chew on this week. Are you actually taking full advantage of the tax-deferred accounts available to you right now? Are you building your own massive financial snowball? Seriously, go check your workplace retirement accounts. Take a look at your IRA contributions and make sure you're letting that money grow as freely as possible. Thanks for hanging out and learning with me today. And hey, keep that snowball rolling.